Welcome to Iron Financial, where we forge stronger portfolios and cut through market weakness. Today, we're putting Bassett Furniture, ticker BSET, under the microscope. Now, they just reported earnings, and the stock took an immediate hit. The headlines look bad, I mean really bad. But you know our job here is to figure out if this is just a surface-level crack or a sign of a real problem in the foundation. We need to know if this thing is about to crumble.
Right off the bat, the CEO is already setting the tone, isn't he? He's pointing to macro headwinds, external factors, all the usual suspects. But, we've seen this playbook 1,000 times. When the numbers are weak, management starts pointing fingers at everything but themselves. We don't trade on corporate spin. So let's look at the raw numbers they actually reported.
And there it is, a nearly 24% miss on earnings per share. Let's be crystal clear. They reported 13 cents, but Wall Street was looking for 17. That's not a small miss. That's a huge gap. And it tells you that the market's perception of this company's health was way off. It's the first major stress fracture we're seeing.
And it doesn't stop there. They missed on the top line, too. Revenue came in at about $80 million, which is more than $4 million below what everyone was expecting. So missing on both earnings and revenue, that's a big deal. The question is clear. Is management just making excuses for a tough quarter, or is this company's entire framework actually starting to buckle under the pressure? Okay, let's get into it. Here's our blueprint for today. We're going to run a full stress test on the company, starting with that headline miss. Then, we'll look for cracks in the top line, see where the pressure is coming from. After that, we're diving into the margins, then testing the financial foundation itself. We'll see if they have a real plan to turn this around, and finally, we'll give you the iron verdict. So we've seen the headline misses, a 23.5% earnings surprise miss and a 4.3% revenue miss. Those numbers definitely shook the market, but just missing an estimate only tells you part of the story. The real question is, how bad is this compared to last year? Is the business actually getting weaker?
And here's your answer. This is the crucial point right here. This isn't just about missing an analyst guess. It's a huge drop from the prior year. Earnings plunged from 21 cents per share all the way down to 13. That is a nearly 38% drop in year-over-year profit per share. That's not just a stumble. The company is significantly less profitable than it was just 12 months ago. Okay, now let's inspect that top line. We're talking about a 2.2% fall in consolidated revenues year over year. It went from about $82 million down to $80 million. Now, on its own, 2.2% might not sound like the sky is falling, but any decline is a warning sign.
Right. Hold on a second. A 2.2% dip? That doesn't exactly sound like the end of the world. I mean, the CEO blamed a weak housing market and even some severe weather. He made it sound like a blip. So, is there more to the story, or are we making a mountain out of a molehill here?
It's not a catastrophe, but it's where the decline is coming from that really matters. Think of it like this. Retail sales, their own stores, were down just 1.4%. Okay, not great, but manageable. The real problem is wholesale sales to external customers. That's down almost 4%. That tells you that other furniture stores are ordering less of their product. It's a sign of weakening demand. And sure, the CEO talked up their President's Day sale, but one good weekend doesn't make up for a weak quarter. The top line showed some cracks for sure, but the real structural damage this quarter was in the company's profitability. This is what we really need to focus on. A small revenue decline should never lead to the massive earnings drop we saw. That kind of disconnect points straight to one thing: collapsing margins.
And here you have it. The gross margin contracted by 80 basis points. That's a concern. But the gut punch, the real problem, is that operating margin. It was cut by more than half. It went from 3% all the way down to just 1.4%. I mean, think about that. For every single dollar in sales, they're making less than half the operating profit they did just a year ago. That is a massive, massive problem.
So what's causing them to lose so much profitability? Is this a permanent problem? Well, it's a mix of things. First, they had lower volume in their upholstery business, which is a core part of what they do. Second, and this was really a self-inflicted wound, they decided to eat the cost of tariffs on some of their products. They say they're fixing that pricing now, in the second quarter, but the damage for this quarter was already done. And finally, when your sales go down but your fixed costs, like rent and salaries, stay the same, your profitability gets squeezed. It's a painful combination. Okay, so sales are down and profitability is getting absolutely crushed. This sounds really bad.
So the big question now is, how's the actual foundation? Can the company's balance sheet handle this kind of stress, or are we looking at a house that's about to fall down?
And this is where the story gets really interesting. Because when you look at the balance sheet, the framework looks surprisingly sturdy. Their current and quick ratios show they can cover their short-term bills, no problem. And their debt to equity is pretty conservative. They're not drowning in debt. The main concern, and it's a big one, is that negative operating cash flow. They used $5.5 million in cash this quarter just from their operations. They're burning cash.
That all sounds pretty good on the surface. But are there any hidden warning signs? Any stress fractures that we can't see just by looking at the basic numbers? Well, there is one. We ran the Altman Z-score, and it comes in at 2.37. And this number, it brilliantly illustrates a potential risk that you might otherwise miss.
Now, for those of you who don't know, the Z-score is a formula that's used to predict the probability that a company will go into bankruptcy. A score below 1.8 indicates distress, while a score above 3 is considered safe. Bassett's score of 2.37 puts them right in the middle, in what we call the gray zone. So they're not in immediate danger, but this is a clear sign of moderate financial stress that we absolutely have to watch.
So what we have here is a mixed bag. The operations are weak, but the foundation seems decent, even with some warning lights flashing. So is management just sitting there, or are they actually doing any heavy lifting to fix this whole situation?
They are making moves. And the brightest spot, without a doubt, is on their digital front. E-commerce sales grew by a very strong 28% in the quarter. I mean, that's impressive. It shows they're committed to their omni-channel model, and it's a part of the business that's clearly working. And that growth is part of a clear three-pronged strategy. First, they're cutting costs. They're aiming to save $1.5 to $2 million a year. Second, they're leaning into that digital growth. And third, they're still investing in physical expansion, with new stores being built in Cincinnati and Orlando. It's a plan, you have to give them that.
Okay, we've run the stress test. We've inspected the cracks, the margins, the whole foundation. Now it's time to assemble the final blueprint. So let's lay it all out. What's the argument for buying this dip, and what's the argument for running away as fast as you can?
All right, the bull case is built on a solid foundation. You've got the strong balance sheet, that incredible e-commerce growth, management is cutting costs, and the stock is trading near its lows. It looks cheap if you believe in the turnaround story. But that bear case is powerful. I mean, the core profitability of this business was just cut in half. They're burning cash, the housing market isn't helping them at all, and that Z-score tells you there's real risk here. This could be a classic value trap.
So here's the final verdict. The operational performance is weak. It is showing clear signs of stress. Now, the financial foundation, it does remain solid for now, and management has a credible plan to try and reinforce the structure. But for us at Iron Financial, that collapse in the margins is just too severe to ignore. This isn't an opportunity, it's a trap, at least until management proves they can stop the bleeding and rebuild profitability. The frame might be solid for now, but the interior is crumbling. That's why we're staying on the sidelines. The key takeaway for investors is to watch that operating margin. Until it shows a meaningful recovery, the risk here just outweighs the reward. That's the Iron verdict.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.